Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service financial services firm headquartered right here in Boulder, Colorado. Today I want to talk about the first quarter and I want to talk about the rest of the year, but of course I'm always going to throw in some general advice because it sounds like I'm a broken record at times because I do bring up certain things over and over again, but I think that they're the foundation of, as I view the world, how clients should be successful. The first quarter, very strong for almost all of these unmanaged stock market indexes, a continuation of an upward trend ever since the election. So November, December just really kind of carried forward into January, February, and into March. I'm doing this video a couple of days before the end of the quarter, so I don't have the numbers right here to spit out at you, but I will include them in the written newsletter. I was with a lawyer friend of mine. We serve on a board together, and we were looking at some solution to a problem. And I'm like, gosh, we really need to have an out-of-the-box solution, and here's an idea. And he's like, Mike, that sounds like an out-of-the-box idea, but it really isn't. I've been a lawyer for 30, 40 years, and that's what everybody always comes up with. I'm like, okay, great. I've kind of felt stupid. But the reason why I brought that up is from his point of view, he hears it time and time again. But to the person who's bringing it up, it sounds new and unique. And I've now been doing, meeting with clients, been in the investing world, the financial services world for coming up on 26 years. And I have seen ups and downs and sideways. I've seen kind of everything that can happen over 26 years. And when the unmanaged stock market index, the Dow, was at 10,000, people would come in and say, well, it's quite obvious that the market is at a top. And I'd be like, really? Why is it obvious? And then, of course, when it's at 12,000 and 15,000, and then it's, taking a little while to go from 18 to 20, in the last year or so. But it's like, well, it's obvious at a top. And even now, as we end this quarter, every once in a while, I hear someone say, it's so due for a correction and it's obvious that it's at a top. And my answer is, well, there's always corrections. I mean, you've seen that chart probably, and I'll throw it up on the screen again at some point during this video, but it's normal for there to be, declines in the market of some type. That's the normal. That's not the abnormal thing. And so that's just part of investing. And so while it might seem obvious that we're at a top or that something is happening from your point of view, nothing is obvious. The future is always being written. And we as investors are always making probabilistic, predictions. Hey, I believe that having a diversified portfolio is probably going to be good for me, and this is the probabilities of it. Or I ought to have all equities, let's say, one person might say, or I need to have all bonds. These are just probabilities that we're placing about the future, but the probabilities are never 100%. And so when someone comes to me and says, well, it's quite obvious, nothing is obvious, okay? I was meeting with the wonderful couple. I've known them actually, one of the two, for a long time. It was wonderful that both of them are just about to graduate med school. Great meeting. And we talked about investing, and I said, well, gosh, in your world, there's probably, simple things and complex things. In order to have a good life, you probably have to eat well, exercise, and don't smoke. And they kind of laugh and like, yeah, that's probably about the best 3 pieces of advice. And I said, well, in my world, it's very similar. It's know what your income and expenses are on a monthly basis, and make sure that, your expenses, of course, are not greater than your income. Number 2 is avoid stupid stuff. Okay, that Chihuahua farm sounds great, or some investment sounds great. Kind of avoid stupid stuff. And then 3 is know that there's going to be things that are going to happen that might derail you from your plan, and that might be the loss of your spouse, the loss of the ability to work. Things that perhaps can be fixed by buying some insurance, okay? And so it's understanding those things that we can control and those things that we can't control, and being comfortable with the things that maybe we can't solve, but also having a backup plan, whatever that might be. Or that backup plan might be, I'm just going to have to, deal with it. I'm just going to have to minimize the impact that it can have in my whole plan, but I'm probably going to have to suck it up and maybe just kind of move through it. And so that's it. Let's not overcomplicate reaching our financial goals by spending so much focus on those things that we might not be able to control. I'm going to put up on the screen that first chart that I talked about, which is the red numbers at the bottom are the it's normal for there to be declines, intra-year declines. And you can see that it's normal for there to be double-digit intra-year declines. However, you can see that the vast majority of years are positive, and when we add them all up, at least historically, that has been in the favor of the investor and the long-term investor. If you need your money short-term, you probably shouldn't have your money in there anyway, because by the time the business cycle, it's still in the middle of the business cycle, you might need your money. And so you don't want to do that. So understand your risk tolerance, understand what your time horizon is, and then of course a portfolio that fits for you, individualized for you. The second chart that I'm now throwing up on the screen is the benefits of being diversified and also having a long-term horizon. The three columns on the left-hand side are 1 year. So this is going all the way back to 1950. And you can see that in 1 year, there can be a huge variance, huge ups and huge downs. You can see that bonds is that middle bar there, ups and downs again, okay? And then a mixture of the two, 50-50 in this case, of two unmanaged indexes of stocks and bonds. But you can see that when you look out 5, 10, and 20 years, a mixture of them, there's actually never been a 5-year, 10-year, or a 20-year where you haven't at least broken even or made a little bit of money in a diversified portfolio, okay? So the future could absolutely be different. However, we're dealing with probabilities here. We're trying to do the best that we can as investors and keep our eye on the long-term advantage to you, which is reaching your financial goals, possibly passing it on to the next generation, income for you, etc. And so I think that is one of the key ingredients in reaching it, not whether or not the market's at a high or it's going to wait, you're going to wait for it to go down 5 or 10% and then buy in. I mean, if you're going to in this for the long term, you need to make the decision and move forward, okay? Because the number of times that the number of times I've seen people lose more money trying to avoid the decline is more than what they would have lost in the actual decline, because they're sitting here waiting out, and the opportunity cost to them about what they would have had, the perfect time to be in, is more than what they would have had to maybe purchase in at the imperfect time, but then understand that they're in this for the long term, that it might go down before it goes up. I continue to be optimistic about 2017. I think that all the ingredients are there when you're looking at momentum in the market, a very pro-business environment, consumer sentiment, lots of money, lots of cash there on the sidelines. I think that if there is a potential tax change, corporate tax change, a repatriation of capital back into the United States. These are all very positive moves that would help us out as investors and people who are trying to invest for the long term and and have good portfolios. So I'm still continuing to be optimistic. Understanding that we've got to find the portfolio that works for what we want to do, individualize, etc. So if you're my client, of course, I've talked with you and we can talk about that some more. If you're not my client, you should be. Shame on you. Give me a call or meet with your advisor and find out what might make sense for you. But great first quarter. I think it's going to continue. The probabilities, as I read the things, are good. But let's keep our basic common sense in, which is what's your time horizon, what's your plan, what's the mix that's going to allow you to stick with your plan, and of course be diversified and keep your emotions in check and be rational about this thing. Okay, and understand those things we can control and those things we can't. So anyway, that's enough for me today. I think I'm rambling on. I'm going to try to be a little bit better on getting these videos out more regularly. Always feel free to give me a call, and I'm here at your service. Mike Brady, Generosity Wealth Management, 303-747-6455. You have an awesome day, awesome weekend. Thanks. Bye-bye. See you. Bye-bye.